Hi, and welcome to Taxes. I'm your friend Frankie Guzman from Valley Village, California. I want to help you understand and explain to you how taxes affect certain aspects of insurance. And the first way we're going to take a look at it is through death benefit, and more specifically in a lump sum form to your family, paid to your family. I don't know about you, but I tend to go to my family reunions, and every time I do, I'm on the hunt down for Uncle Sam, but I can't seem to find him. Now, is there a way to not pay any taxes to Uncle Sam? Because we've been charged taxes since the day we started working, am I right? Well, yes, there is. And the surefire way not to pay taxes to Uncle Sam is by buying life insurance. Why? Because upon your death, when your family receives the death benefit, it is 100% tax-free. That's right, your family will not be charged any taxes on a federal and even on a state level. The only downfall is you gotta die. Only downfall. Let's move on. The next way is called installment options, okay? An installment is when you choose a certain amount of money to be left to your family. Now, I'm going to share this with you. I love my wife, totally love my wife, but she has a small little problem, and that's called spending money. Now, if I were to leave my wife a check for $500,000, the possibility is I might not get buried, okay? So I might not want to leave my wife the whole lump sum amount and just tell the insurance company to pay her a little bit at a time, like $10,000. By giving my wife $10,000 a month until the money runs out, I potentially could be buried, and that'll last her a little longer, okay? Now, whenever my wife receives that $10,000 check, a little portion of it is going to be taxable because it's interest and growth. Let's take a look at your example on the screen. If you notice, you have a $10,000 payment to the family. $9,000 of it is all proceed, so that portion is all tax-free. But notice we had $1,000 growth, so my wife is going to have to pay taxes on that $1,000, okay? Next, we're going to take a look how taxes is affecting individual premiums. Unfortunately, for individual people, it's a personal expense, not a business expense, so we cannot deduct it from gross income, okay? Next, we're going to take a look how taxes affect dividends. Now, the definition of a dividend is a refund of overcharged premiums. It's basically your money being returned right back to you. So if you are in a participating policy that participates in dividends and a dividend is declared, then when you receive that, it's all tax-free. But you know you actually have an opportunity to have that dividend grow, accumulation at interest. When there's any growth experiencing on that dividend, the portion that's interest, the portion that's growth, that'll be taxable to Uncle Sam's income. Next, we're going to see how taxes affect policy loans in a cash value policy. When you take out a loan, when the policy owner takes out a loan and receives that proceed or receives that check, no taxes, no tax consequences. Next, we're going to see how taxes affects surrendering the policy of a cash value policy. Now remember, surrendering means cashing out the policy, cashing out the money from the cash value. And when you receive the cash value, and if that amount exceeds premiums paid into it, any excess will be taxed. Now I hope this helped you with taxes, and as a review, there's different aspects of, different ways that taxes affect different aspects of insurance, and we saw how it affected death benefit, settlement options, premiums, dividends, policy loans, and cash surrendering. Thank you for tuning in.